Hello, my name is Bob Baird. I've been in the financial services industry for over 25 years, have a background in economics from Dartmouth College, and for years I've followed a series of accurate price predictors for real estate, interest rates, and the economy in general. In the next few minutes, I'm going to give you the best information currently available to give you the confidence to take advantage of possibly the best real estate opportunity we will see in our lifetimes. Yes, I believe the current interest rate combined with the affordability index of real estate prices is going to be looked at 10, 20 years down the road as the good old days. So sit back for a bit and see exactly why I believe that right now is not the time to be squeamish about buying. The most important economic fundamental is inflation. It's the key driver of everything the Fed does. If it ticks up above 3.5%, the Fed goes into a tightening mode. But in spite of what you may hear, this is very likely a long way off. Economic growth and demand is simply too weak to create inflation. So this means the Fed is very likely going to keep rates as low as they can. And this means that lines of credit, adjustable loans, and the prime rate are going to stay historically low, but will go up from these levels. The primary reason for this economic malaise is unemployment. It's going to get worse before it gets better. Now, politics could play a major role in how the economy goes, but all things being equal, our model is predicting a double-dip recession in 2011. This is also going to keep rates relatively low, and this is going to keep pressure on the Fed to keep them there. All of these statistics point to lower than average mortgage yields when you look at it on a historical basis. But if you look at the model closely, you see that we may have already seen the bottom, and this model is predicting a generally higher interest rate environment in the coming few years. The reason for this on a cyclical basis is pretty obvious when you look at this chart. This is a 10-year Treasury bond chart. It goes all the way back to the Reagan era. And as you can see, prices tend to bottom, or rates tend to bottom, about every 5 years. We're currently right near the lows of where we struck in 2009 at the worst part of the economic disaster that occurred at that time. But what it also says is that for the foreseeable future, for the next few years, we're going to be in a generally higher interest rate environment, albeit a historically and relatively low interest rate environment. So what does this mean for you, the home buyer? This slide shows data for the past 20 years. Houses right now, based on income, interest rate, and prices, are 50% more affordable than 20 years ago. In fact, homes were less affordable in the 70s than they are right now. But there's a trap consumers frequently fall into. They think that prices are going to just keep going down. If you're a cash buyer, obviously price is the most important factor. But if you're the average buyer who's using a loan to purchase his real estate, what is most important is your payment on your loan. Now this depends not only on price, but interest rates. Now in this slide, I use an exaggerated example to make a point, but here you essentially have the same payment for a $290,000 loan at 4.5% as you would for a $200,000 loan at 8%. Now, which home would you rather have? So today, we not only have to look at price expectations, but interest rate expectations. Now, recall that we were expecting essentially higher rates for the foreseeable future. What's this going to do to your payment? This slide shows how much it costs more per $100,000 loan amount for each 1/4 point in rise in rates. A full point higher, say from 5 to 6, in $100,000 costs you $22,000 over the life of the loan. Double that for a $300,000 loan. Quadruple it for a $400,000 loan. Now, it's obviously not very difficult to believe that we're going to go back to where we were in the recent past. Well, 18 months ago, rates were in the mid-sixes. But here's what they are now. This is a price of mortgage bonds and what they've done basically since the year 2010. From April up until November, rates went from 5.25 down to 4%. Now, this was primarily due to a flight to quality to our treasury bonds as a result of the European debt crisis. It wasn't because of our own economics. International investors were simply afraid of being in euros and wanted U.S. treasuries. Now, should another crisis occur, we could see even lower rates, but my guess is that we've probably seen the lows and should prepare for an uptick in the near future. And that means you should look to buy now. Here's a realistic example of what you can expect. In this case, we show the likely cost of waiting in today's market. Let's take a look at what might happen for a $400,000 house purchase with an FHA loan at current rates, or about 4 3/8. Now you compare this with a comparable loan if home prices dropped 5% from $400,000 to $380,000. But also, while these prices dropped, interest rates went back to normal, say 5.25. Now, looking at the previous chart, it's not at all surprising, or it wouldn't be at all surprising, to see prices come back down to this level, or rates back down to the 5.25 rate. And as you can see, in this particular case, even though the loan amount is $366,000, almost $20,000 less than the other loan amount, the payment's higher. This costs $84 a month, $11,000 when you include principal and interest in 5 years, and in 15, $36,000. Bargain hunting just might be a very expensive occupation. Now, any economic forecast can be right or wrong, especially in hindsight. But I hope what I've shown you today is that even if some of these predictions turn out to be wrong, even if prices do go a little bit lower or rates go a little bit lower, prices and rates are so good right now on a historical and immediate perspective that it begs the question. If you are in the market for purchasing a home, can you really afford to wait? I think not. I help people every month with making the most important financial decision of their life. Houses today are a screaming bargain. Don't wait for the crowd to get this message. Eventually they will, but when they do, rates and prices are going to be a lot higher then. One final comment. Your CPA helps you with your tax planning. Your financial advisor helps for your retirement planning. And your realtor helps you get your house. A good mortgage professional helps you integrate all of this into a uniform financial plan tailor-made for you. This is what I do. Let me help you with that process. This is Bob Baird, Disney Financial.